Hello and welcome to the IME Webinar, Beyond Fixed Deposits, where we delve into smarter fixed income options for better post-tax returns. I am Shagun and I will be your host for this event. I want to thank all of you for joining us on this Thursday evening. Today, we're talking about the alternative space, which has been growing exponentially. And who better to take us through some of these options than Ashi Anand, the founder of IME Capital. Ashi has been part of the alternatives industry since 2002, and he has been responsible for designing and launching a number of innovative structured products. Before I call Ashi in, I just wanted to say that if any of you have any questions, please do type them in the chat box and we will answer them all together in the Q&A session in the second half of today's webinar. So without any further delay, Ashi, let's bring you in and the floor is all yours.
Thank you, Shagun. Thanks so much for the introduction, and thanks all the participants who have joined today's webinar. I hope you do find today's webinar quite interesting. We are kind of really looking at kind of exploring a lot of fixed income options that just in our experience, very often investors may not be completely aware about. So to just kind of lay a framework in terms of how we'll be proceeding with today's discussion, this is going to be the broad agenda. We'll first have a very quick look at what the different investment options are to give you a sense of what the kind of investment landscape is when we are looking at fixed income or fixed income plus investment options. The second segment will really focus on the traditional options. The bank fixed deposits, debt mutual funds, corporate bonds. Now, these are some of the more traditional fixed income options that a lot of investors may be a lot more aware about. We'll talk about why we believe there are certain fundamental problems in the segment, primarily related to tax and certain other issues. We'll then effectively look at what we believe to be the superior mutual fund options. These are basically mutual fund categories that, while still operating within a fixed income domain, are a lot more tax efficient, are lower risk, and are also continue to be fairly liquid. The last part of today's webinar will really focus around the very rapidly evolving alternatives landscape in India, where there are a number of very interesting, sophisticated, more complex kind of options with very diverse risk rewards. So we'd cover kind of absolute long short, debt AIFs, your asset yielding AIFs, venture debt AIFs, some of the new age tech platforms within this. The broad idea is to give you a quick overview of what the different investment options are. Now, before we actually start, a few important kind of points that I think are important before we begin. There are kind of returns that are indicated at various points in time over the presentation. Please understand that these returns are only for illustrative purposes. They are based on various assumptions which may or may not hold true in your specific case. Your actual investor returns can vary substantially. Please look at this only from an illustration perspective. Secondly, the actual relevance of any of these options in your portfolio requires a much deeper assessment of your goals, your risk profile, liquidity, and other requirements. Just look at this as a understanding of the options that exist as compared to specific investment recommendations, which really requires a one-on-one consultation. There are a diverse set of investors on today's call. For some of the topics may be relatively kind of easy, or they may have heard of them. For certain other investors, some of the topics may be a little more complex. It's structured in a manner that we're kind of starting with some of the easier options and then we move to the more complex ones. It's important to understand that given the time that we have for the webinar, we'll be looking kind of covering the options out in about 30 to 40 minutes. We really don't have too much time to go into the nuances or the inner depths of how each of these options actually work. Look at this as getting a larger snapshot view, and you can always connect with your IME private banker to understand these options in greater detail and understand whether they are suitable in your specific case. Now, that said, this is broadly what we are going to be covering in today's session. There are a wide range of investment options that exist in what could be considered fixed income or fixed income plus type investing. These investment options vary quite significantly in terms of their returns. Now, an important point we are going to be stressing on on today's webinar, and as we go through each of the investment options, is while investors very often focus on pre-tax yield, you really need to understand the yield that you're making in the context of the tax rate that you get subjected to and the kind of risk that you are taking. And accordingly, according to us, what is a lot more important is understanding what are your risk adjusted post tax yields. And as you can kind of just broadly see on the slide, you range from kind of investment options where there is very low risk, but the returns are also very low. And you kind of move up to kind of investment options where you can make kind of much higher returns, but it does kind of come with a higher level of risk. So there are different kind of options that exist. We'll be kind of understanding the pros and cons of each of these options as we going along today's webinar. This is just kind of a graphical representation of the previous slide. As indicated, there are kind of different investment options across the risk return spectrum. And we can be kind of going through each of these as we're going along. So let's just start with what are the traditional fixed income options, right? And these are kind of the fixed income options that most investors on the call would probably be quite comfortable with. Starting with what is clearly kind of probably the best understood investment option in terms of fixed income, which is bank fixed deposits. Now, the good part about bank fixed deposits is that it is relatively easy to understand. You're giving your money to a bank, you know the return that you're going to get, and these returns are assured, and there's also a perceived level of safety. Now, this is what makes kind of bank fixed deposits very popular. But from anyone who's kind of active in the investment landscape would know, these are considered amongst the worst investment options. The first and the biggest problem is in terms of how bank fixed deposits are taxed. They're taxed at your slab rate, and they're also taxed every year, regardless of whether you are redeeming money or not. Um, the second element is that when you are putting money into bank fixed deposit, you have to indicate your time horizon at the start. And if you need money before, if you need to break part of the fixed deposit because you need to make a partial withdrawal, all of these things can come with premature withdrawal penalties and other such costs. The last element is that if you notice when we use the word perceived when it comes to safety, and this is because there is a implied kind of a guarantee, or investors kind of think that there's a guarantee, but in reality, all bank fixed deposits only have a 5 lakh insurance cover. And just kind of theoretically, if a bank were to go bust, investors could technically lose all their capital. And we've actually seen something like that happen in the case of a Yes Bank, not in the case of bank fixed deposits, but holders of the tier 2 bonds did actually lose all their money. So it is kind of important to kind of understand that while bank fixed deposits do have assured returns and are easy to understand, your post-tax yields are exceedingly low and you don't even really cover inflation. Now, what used to be the most popular alternative for bank fixed deposits were debt mutual funds. And you have debt mutual funds of a wide variety of types. Basically, debt mutual funds get classified on the basis of the maturity. What is the duration of the papers that they hold? And the reason that is important is uh, mutual funds that invest in lower duration papers have lower interest rate risk, and mutual funds that invest in higher duration paper have higher interest rate risk. Essentially, when interest rates in an economy fall, bond prices move up, and therefore you want to be kind of in long duration funds when interest rates are falling. But when interest rates rise, you can actually lose a lot of money. So that's the first element about trying to understand debt mutual funds. And the second element is around credit risk. There are kind of mutual funds that invest in different types of bonds of investors with different kind of credit worthiness. If you're lending to kind of lower rated paper, you get higher yields, but it comes with a higher level of risk. Now, just for people who aren't aware of what a debt mutual fund is, a debt mutual fund works identically, very similar to an equity mutual fund. An equity mutual fund holds a portfolio of equity stocks. A debt mutual fund will hold a portfolio of debt securities, with the type of debt securities determined by the category of the debt mutual fund. Now, the debt mutual funds used to be very popular because there was a favorable tax regime until 2 years ago, where you actually had long-term capital gains being taxed with indexation benefits, but that has effectively now gone away. And debt mutual funds are now being taxed at the slab rate, which for investors on higher tax slab is 39%, really takes away a substantial part of their return. And this is why most kind of savvy investors are moving away from debt mutual funds towards some of these newer mutual fund options that we are talking about. But just to give you a context of the lower risk debt mutual funds, these would be debt mutual funds that are investing in papers with lower duration or lower maturity and lower credit risk. Um, the benefits of a debt mutual fund over a fixed deposit. Firstly, a debt mutual fund is taxed only on redemption versus a bank FD being taxed every year. The second element, and this is also quite important, is that debt mutual funds and most mutual funds are very, very flexible. You can make incremental investments and redemptions very, very easily without kind of premature withdrawal penalties. They are also extremely liquid. You put in a redemption, you get your money back on a T+1 day. If you look at kind of historical kind of returns on debt mutual funds, you would actually kind of notice in the lower risk category, your returns are actually fairly similar to what you would expect in bank fixed deposits. There is another element of debt mutual funds, which are debt mutual funds which are slightly higher risk. Now, these are debt mutual funds which should invest either in lower rated bonds or longer duration securities. They come with higher interest rate or credit risk. Now, this is suitable only for investors who really understand this and with a higher risk tolerance. Effectively, what happens is while you are getting a higher amount of pre-tax returns, if you look at the volatility of returns, it's actually considerably higher as compared to your lower risk debt mutual funds, especially if you look at your longer duration debt mutual funds. When interest rates are falling, you can see they can give very high returns, but when interest rates start rising, returns can go down very significantly. This accordingly is only kind of a segment which makes sense for people who really understand interest rate cycles and how to invest based on where the cycle is. The last part amongst traditional options is basically corporate bonds. Now, these are investors who invest directly in corporate bonds, and depending on who you are lending to and the level of maturity, there's a very wide range of yields that are available. You could see yields moving from kind of 7 to about 14%. Now, while these are popular because one, you can make potentially higher yields in a bank fixed deposit, and your returns are known upfront if you are holding them to maturity. However, this is a segment we normally recommend our investors staying away from. And the main reason that if there is a credit event, 100% of your capital is at risk. And if you kind of just seen the kind of if you just seen the kind of credit cycle over the last decade, you have seen a number of what were very highly rated corporates actually go out and default. Now, if you were unlucky to be holding any of these papers, you actually stood a chance of losing 100% of your capital. And this incremental yield on a corporate bond, according to us, just does not justify the risk of 100% capital loss. The only way to invest in corporate bonds for an investor who does is to have a very high level of diversification. We're talking of a minimum of 40 to 50 papers. And that is something which can be quite challenging for a lot of investors. And it is primarily from this context that we actually don't recommend that investors look at kind of corporate bonds unless they really understand what they are doing. The other element is that because corporate bonds are being taxed at a slab rate, it is really your pre-tax yields that are looking very attractive, but kind of post-taxes, your returns really are not that high. So this just kind of covers up the kind of historical and the traditional kind of options that exist and are fairly popular. And what we are going to now focus on is what are the kind of tax efficient fixed income mutual funds. And we are going to be using kind of arbitrage and fixed income plus arbitrage equity savings. We're going to be using the term fixed income a little loosely here to include certain funds which have fixed income type risk return, but may not necessarily be classified as a debt fund. Now, the first and the most popular category is what is called arbitrage fund. All smart money that was in debt mutual funds have effectively moved to arbitrage funds over the past couple of years. Now, just to kind of understand what an arbitrage fund is, arbitrage funds are funds that invest in risk-free arbitrage opportunities. They're price differences or price divergences between a stock in a future market. And these need to converge on maturity. So just to kind of give you an example of how this operates is say there's an Infosys stock and there's an Infosys future. You can buy, the future will almost always be trading at some form of a premium to the stock at the start of the month. So what arbitrage funds do at the start of the month, they will buy the stock and they will sell the future. They hold this position till maturity, and on maturity, on what's called expiry, the price of the stock and the future by definition has to converge. It is the exchange definition that the closing price of the futures contract is equal to the closing price of the stock. There is no risk, no uncertainty here. Now, effectively, what this means is that regardless of what happens with the stock could, we've just taken kind of the stock in red and the futures in green. If the stock price moves up, the futures price that you've sold will move up less, and you will basically, these two prices will converge. You have bought something at a lower price, you've sold it at a higher price, and you're reversing this trade when both the prices have converged. This premium is what you get. If the stock price remains absolutely flat, the futures price will come down to that and you'll get your premium. The same thing in a down market. This is a absolutely risk-free kind of transaction, and which is where your risk reward is very similar to kind of very low risk debt mutual funds or your bank fixed deposits. Now, it's not that your yields are higher in arbitrage funds because these are risk-free. Your arbitrage spreads converge to the overall kind of low risk, low duration, risk-free kind of rate that exists in the markets. But what makes arbitrage funds very efficient is the way they are taxed. Arbitrage funds are taxed similar to equity, which is for holdings of less than 1 year, it's a 20% short-term capital gains, and for holdings greater than 1 year, it's a 12.5% long-term capital gains. Now, effectively, what this means is for people on the highest tax bracket, you're really looking at a 39% taxation versus a 12.5% taxation, and therefore the post-tax yields can be significantly superior. We find arbitrage funds to be the best alternative for traditional bank fixed deposits or debt mutual funds in the market today. There's extremely minimal risk. They are very tax efficient. They're also very liquid. You get, if you put in a redemption, you get your money back in T+2 days. However, the main problems is that this is a category which may not be as well understood. While it is a category that has existed in the market for over 2 decades and is large and popular, because debt mutual funds were actually tax efficient until 2 years back. It was really debt mutual funds that was getting the bulk of the money. It's only over the last 2 years that arbitrage fund has become the kind of de facto fixed income option. And given its kind of tax efficiency, the kind of liquidity, the ease of incremental investments, withdrawals, we really find this to be the most suitable investment options for traditional bank FDs or your debt mutual funds, especially for investors who do not want to take any incremental level of risk. There is a new category that has very recently been introduced, and we're just talking about 3 to 6 months ago. Now, this new category is basically what's called income plus arbitrage fund. These are funds which have invest about 65% in traditional debt securities and about 35% in arbitrage. The reason they are structured in this manner is that, similar to arbitrage fund, these funds also benefit from lower equity taxation. However, there are a few nuances. This category actually has been specifically created because we were in a high interest rate environment. Interest rates were expected to fall, and debt securities would actually have the benefit of mark-to-market gains in such an environment. In a falling interest rate environment, traditional debt or traditional bonds would actually outperform arbitrage. And which is why, if you're seeing, we are showing here that the returns would be greater than arbitrage in the case of falling interest rate environments. However, in the opposite environment, when interest rates have fallen and they're actually moving up, your returns would actually probably be lower than arbitrage funds. The other important element is arbitrage funds enter long-term capital gains after a 2-year holding period. Your income plus arbitrage actually enter long-term capital gains after a 2-year holding period. So it's 1 year for traditional arbitrage and 2 years for income plus arbitrage. The other difference is that in traditional arbitrage, if you sell while you're still in short term, in traditional arbitrage, you're taxed 20%. Here you'd be taxed at your slab rate. So this is a new category. It is niche. It may be a little more suitable for the next 1 or 2 years. but we really see arbitrage as being the more predominant category over the longer term. Now, the other category, which has become again very, very popular over the last couple of years, is what is called equity savings. Now, this is actually a hybrid fund. It's a combination of one third equity, one third arbitrage, and one third debt. Now, the reason this category is interesting is that this 33% that you have in equity give you the potential for about 2 to 3% higher yields that come in with a relatively low level of risk. Basically, as compared to a traditional 6 to 7% that you'd make in debt, equity longer term should give you about 15%. On one third of your portfolio, you're making about 9%, 8 to 9% higher yield. That gives you kind of a 2 to 3% higher return on average. The way these are also kind of structured is that because there's only one third in equity, uh, this category typically can give you a flat return and not lose you money, even in conditions where equity markets fall by about 15%. The way this works is that if equity markets fall by 15% on your one third equity, you lose about 5%. But that 66%, which is lying in debt and arbitrage, which is making you 7%, actually gain 5%, and these two kind of net each other off. Now, the reason this category is becoming popular is that you have the potential to make a 8 to 9 or even a 10% post-tax yield. These are tax similar to equity funds. And even in a kind of a bad market, you are kind of unlikely to lose money. It's only if markets fall more than 20-25% in a particular year could you actually see a negative return. And even in terms of larger market falls, you are kind of still insulated by the fact that about two-thirds of your portfolio is in traditional debt. If you just look at the last decade kind of returns, and these are the average returns across equity savings funds that we recommend, you've actually not seen a negative year over the last decade. Now, this is something that I think a lot of our investors, especially post debt mutual funds, having been moved out of kind of favorable taxation, a lot of them are seeing this as a reasonable level of risk to take. They are comfortable not making money in a particular year as long as they don't lose a substantial amount of money. But the ability to sit and kind of make a 2 or 3% return as compared to a 2 to 3% incremental return or 8 to 9% post-tax yield, as compared to kind of the 4 to 5 or 5 to 6% in bank FDs or arbitrage, is what makes this kind of really attractive for a lot of investors. Now, with this, we end our segment about the traditional kind of options and the kind of mutual fund options that exist. Effectively, the way we look at the space is that you have these traditional options of bank FDs, your debt mutual funds, and corporate bonds that we don't have on the slide. All of these basically suffer from kind of being very tax inefficient. And while pre-tax yields may look attractive, the moment you adjust for tax, you very often are not even making up for inflation, and you're actually losing money every year. For investors who don't want to get into some of the most sophisticated options, we believe arbitrage, income plus arbitrage, or equity savings make a lot more sense. So this is, sorry, just give me one minute. So this is basically the range of traditional options that exist. With that, let us move to the next segment of the webinar, which is really understanding the alternative space. Now, a lot of the alternatives that we are talking about are all what are considered alternative investment funds or AIFs. It's important to understand that the vast majority of these would have a 1 crore minimum investment size, and therefore may or may not be appropriate for all investors. The other element is a lot of these are slightly more complex and do have slightly more sophisticated risk reward that we will try to kind of cover in today's conversation. So kind of starting with the first category, which is what's called absolute long short. Now, this is a lot more sophisticated version of arbitrage. Or your arbitrage funds are basically buying and selling a future. Your absolute long short funds are basically have the ability using derivatives. Now, there's what's called futures, call options, and put options. You can buy or you can sell these. These allow you to basically be able to create a position that is designed to make you a return if markets are moving up, or you can design a strategy that's designed to make you a return when markets are going down, or you can also create a strategy designed to make you a return if markets are flat. You can make very kind of complex strategies tailor made to be able to perform in a specific market strategy. And an important element when you're looking at kind of long short is when we are talking about long short in the context of fixed income, we are only talking about what are called market neutral absolute return long short strategies. These are strategies that are really focusing on trying to kind of build positions where the long and the short positions broadly cancel each other out so that you aren't really exposed to the market per se. The whole aim is to generate a small positive return every month. This is typically in the range of 0.75 to 1.25%. Most of these funds are kind of aiming towards making a return of about 10 to 16%. They use really complex strategies. These are just some of the kind of names of the kind of things that these funds do. It is very complex maths that is involved, and a lot of investors don't really understand this. But just from an investor perspective, it's important to understand that what you are really betting on is the fund manager's ability to be able to take a call on the market and to create a strategy that is designed to be able to generate a positive return in that particular market condition and also be able to react very rapidly if that call changes. Um, you are typically here looking at kind of returns in the 10 to 16% range pre-tax, which after kind of fees and after taxes, you should expect returns in the 5 to kind of 8.5% range. The main, the good part here is the ability for these funds to generate a positive return in any kind of a market condition. They also have very low correlation to traditional debt and equity strategies. And they also still are, these are amongst the most liquid alternatives where you normally can get liquidity every month. The main problems are that one, there is a very high level of complexity. Very few investors, and I would argue even advisors, really understand the nuances of what is happening inside this fund. There is a very high level of fund manager dependence here. There are only a few specialized managers that do exist in the space. And you are really dependent on the manager being able to sit and execute these strategies properly. So that's what's the called absolute long short. And these are kind of funds you can expect a kind of a post-tax yield here with 5 to 8.5%. Honestly, without a lot of risk. It's more complexity rather than a lot of risk that is there in the segment. And which is why if you're looking at the kind of post-tax, the pre-tax and the post-tax yields, they aren't as high as some of the other alternatives. Now coming to kind of debt AIFs, and debt AIFs are nothing but debt mutual funds, but in an AIF structure. But the moment you're looking at a debt AIF, these would typically be funds that are lending to borrowers that are considered too risky for your traditional banking, NBFC, or debt mutual fund channels to lend to. You accordingly can get a higher level of yield, but it comes with a higher level of risk. We have divided debt mutual fund into two categories. The first category is what we kind of call your performing credit. Now, these are kind of AIFs that kind of lend in the AA to triple B minus segments. And in these segments, these are still kind of considered investment grade or investment worthy. Your pre-tax yields, while being higher than debt mutual funds, are not substantially higher. And effectively, what this does is it gives you a decent blend of risk reward. You are getting kind of higher returns, but you aren't taking an inordinate amount of risk in order to try to generate those returns. This, however, does come, that very statement does mean that your returns are not that much higher. And because you are being taxed at your slab rate, your post tax returns of 5 to 7.3 honestly don't become very different from what you can actually generate in an arbitrage fund. And very often, equity savings funds can actually give you returns that are even higher. The other important element is that while risk is manageable, it does still exist in the case of the performing credit category. The other category of debt AIFs that is again quite popular is what are called your high yield debt AIFs. Now, these are debt AIFs that invest in much higher yielding but riskier bonds. These would typically be bonds that are rated either double B, so it's below investment grade, or they're not rated at all. You're typically looking at taking on one of these kind of higher risk. You're either investing in more complex lending, mezzanine lending, structured lending, promoter funding, etc. All of these are areas where you have faced asset quality issues in the past. Or you are lending to kind of sectors that are known to be riskier, or you are lending to corporates that are known to be riskier. Every one of these AIFs would have on their presentations, and if you meet the investment teams, would have very strong kind of uh, claims around what they are doing in terms of the measures to mitigate credit risk and the fact on how they structure things to be able to manage credit events. You'd very often hear about security covers being two, three, four times the amount that they are lending. You'll hear about personal guarantees. You'd hear about kind of escrow mechanisms to protect cash flows. And it is kind of easy to get swayed by a good sales pitch to kind of believe that the way these things are being structured, the risk has been taken care of. Uh, our simple view here is that one, if there is a structure that is able that can be created to help mitigate the risk, the borrower would actually do this on their own and actually use that to borrow much cheaper from a bank or an NBFC and not actually sit and kind of borrow money at 14 to 20%. The moment you have a borrower willing to pay these kind of interest rates, regardless of the structure, regardless of the security, there is a high level of risk. And an important element here is around how security claims are often very hard to enforce in India. Any investor investing in a high yield debt AIF, right? And you have these real estate AIFs, you have all forms of high yield debt AIFs, need to be uh, need to kind of go in acknowledging that there is a fairly high likelihood of a credit event taking place. You are being compensated for that risk in the form of higher yields. And effectively, if you invest in a debt fund and if you're lucky for no credit event, only one of the papers to turn bad, you would actually do fairly well. However, the problem in the segment is that if you actually invest in a debt AIF and the lending cycle goes down and you start seeing asset quality problems in the industry, a lot of these papers could go bad together, right? And we've seen something similar to that when it came to kind of the IMF's crisis, which happened in 2018. The vast majority of these papers that you're looking at, of these companies, all kind of went bust around the same time. And all of these were fairly highly rated papers. So it is important to understand that yes, the returns are higher, but it comes with a higher likelihood of credit events. The other problem we've kind of noticed in the segment, and at IME, one of the main differentiators for especially for those of you who've interacted with us in the past, is we aim to be a research first and a very, very transparent wealth management firm. And accordingly, we kind of always highlight if we see fees that seem a bit out of context. Now, when it does come to high yield AIFs, in our view, a lot of these funds, not all, have kind of performance fees that really work very well in the favor of the fund. You really have the investor taking on a very large amount of the risk, but the fund really taking on, if they actually do well, a very substantial amount of returns can actually go into fees. We have kind of seen fees in the magnitude of about 3 to 5% on a fund kind of yielding about 20, 21%. And we believe those kind of fees are just maybe too high. So if you are ever looking at a high yield debt AIF, just do have a look at the fees quite closely. The other important element is these are illiquid. These are typically close-ended. You should expect your money to be locked in for 4 to 7 years. Extremely difficult for you to get your money back in between. It is close-ended. You invest when the fund closes, when you get your money back. And there is, again, a very high level of team reliance in terms of sourcing, risk management, operations, etc. Now, a couple of other kind of segments of debt AIFs or your kind of fixed income AIFs is there's something called an asset yielding AIF. And this is something which is quite interesting. It's quite new, but a lot of people, especially HNIs, have actually been involved in this historically, right? And actually doing it on their own. Now, what an asset yielding AIF basically does is the fund actually goes out and buys physical rental yielding assets. So you could have a commercial real estate fund which would go buy commercial buildings. You can have infrastructure funds that could buy a toll road. So the fund owns the asset. They sit and they get a rental income stream. It could be rental income for real estate or kind of tolls, etc., for infra. This gives you an annual cash flow that is taxed at your slab rate. But the whole aim is that when you invest in some of these assets, a lot of these assets move up in value over a period of time. They also expect to be able to make a 5 to 7% incremental yield over this kind of rental income that they've generated in the form of capital appreciation. And the benefit here is that this is actually taxed at a lower 12.5% tax slab. Now, this basically makes this category reasonably interesting from a post-tax perspective. You are making a 15 to 20% yield. The way you kind of come to this, and it's really dependent on the kind of risk that the fund, asset yielding fund is taking, but you're making about 7 to 8% in the form of a rental income, and you're kind of expecting another 5, 7, 10% coming in from capital gains. Again, a function of how the fund is structured. You can sometimes boost yields by increasing risk a bit by taking on some leverage at the fund level, which is what lets you sometimes move closer towards that 20% kind of mark. The good part of this category is yields can be quite attractive. Part of your returns are coming tax efficient, which kind of makes the overall tax incidence kind of lower. There's a low correlation to kind of traditional markets. And typically, these funds mitigate risk by only investing in an operational asset where you're already generating yields. You don't take construction risk. The main problem in this category is concentration risk. Most funds here would hold somewhere between 4, 5, 7, 8, a maximum of kind of 10 assets. One bad apple can have a large impact on the overall fund. You're also kind of taking utilization risk and asset pricing risk. Utilization risk if it's a toll road, if a new road comes up, if it's a commercial building, if one of your key tenants leaves and you can't find a new tenant. These are still some of the traditional risks that do exist. So it's not that it's risk-free, but we do find the risk-reward payoff honestly a bit better than your high-yield debt AIFs. You do have some of the other issues around some of these do have higher performance fees, and there is also illiquidity. There is also a high level of team reliance. A similar version of an asset yielding AIF, though obviously actually quite different in terms of what they do, is what are called venture debt AIFs. Now, these are AIFs that are lending structured debt to early and growth stage startups. And these are typically secured by startup assets or future receivables or different elements, because it's important to understand that the moment you are lending to a startup, there is a higher likelihood of some kind of credit event happening. And therefore, it's important that the way you are structuring, the way you are securing yourself against a credit default is fairly important. Now, the way these funds are structured and the way you get to this 15 to 20% kind of pre-tax yield, similar to your asset yielding fund, you have one part of, so when the fund lends in the startup, part of it goes as a loan where you're getting a kind of annual interest income. But you also get typically warrants or options that are give you an equity type upside. These are basically structured in a manner that if the company goes bust, you lose whatever money, as in that option is worthless. But if the company does do very well, they could give you a big boost in returns. It's a kind of a combination of higher risk debt AIF and private equity investing, which leads to an overall 15 to 20% yield. Yields can actually move well below, well out of this, or well above this range, depending on how some of the options do and depending on how the credit risk of your portfolio plays out. Um, Again, it is broken up into your interest income, which is in tax inefficient, and capital appreciation, which is at 12.5%, which is a lot more tax efficient. Again, this is a segment which most of these ZAFs we believe are more sophisticated and more suitable for your HNIs, institutions, investors who really are a little more sophisticated, who understand risk and are willing to take higher credit and liquidity risk in order for potentially higher returns. The last part is a lot of you may have come across new age tech platforms that do peer-to-peer lending, lease financing, cash flow discounting, etc. These can offer attractive yields. Very often you'll hear about high teen, 14 to 18% kind of yields. But the very, very important element here, and we believe this is something which is very underappreciated by investors, is the platform dependence. If that platform, and a lot of these platforms are startups on their own rights, if that platform were to go bust, either because of business operationals, funding challenges, or the fact that regulations change around them, and regulations are really evolving, it could be very, very difficult to get your money back because you are dependent on this platform being around in order for those cash flow mechanisms and the securitizations and all of that to work. Accordingly, given how nascent the stage is in India, given the risk of 100% capital loss in case the platform were to fail, this is again a segment that we normally don't recommend investors invest in. So this is just a quick recap of the kind of alternative space. There are a lot of interesting options, but they do come with their own levels of risk. It's important you sit and understand how that fits within your kind of requirements. And it's very important, according to us, that before you invest in anything, you really understand how it works and does it suit what you are looking for. Ultimately, any of the investment options that we have discussed need to be determined not by that investment option, but by your investment mandate. Now, this is basically a process at IME Capital that we do that looks at your financial goals, your risk profiles, your preferences and beliefs to narrow down from the wide ranges of asset classes, categories, subcategories, etc., to understand what are the specific asset classes, specific categories that make sense for you. It's more important that decisions are driven by your requirements as compared to what a kind of return is that is showing. Uh, with this, thank you all so much for the very patient listening. My apologies if some of this may have been a bit complex. It is a fairly complex topic, and we were trying to cover a very large range of options in a kind of short time span. With that, but thank you once again so much, and over to questions. Shagun?
Yes, Ashi, there are a few questions already actually. Padmanabh Shinoy wants to know what your views are on InvITs like IndiGrid and Power Grid InvITs.
Okay, so when it comes to REITs and InvITs, we actually prefer REITs to an InvIT, and the reason actually we didn't cover REITs or InvITs in today's webinar is we've kind of chosen or focused on kind of funds which are professionally managed. What happens is a lot of these categories have nuances that investors may not necessarily fully appreciate on their own, and they require a deeper dive. Now, the reason we prefer REITs to an InvIT is InvITs very often optically offer a much higher yield. But unlike a REIT, which is typically a perpetual asset, where you're investing in an office building, and yes, every 40 or 50 years, you may have to spend a major amount to rebuild the building, etc. But it is effectively a perpetual asset where your rental income would actually move up over a period of time. A lot of the InvITs are actually structures of that own what are called build, operate, and transfer assets. Effectively, these are limited time infra assets, where after a typically 15 to 20-year period, ownership of that asset is given back to the government. And therefore, when you're looking at that yield has the potential of going to zero some point in the future. And the price of that InvIT could fall quite dramatically. So when you are looking at the higher yield on an InvIT, you really need to account for the fact that over a period of time, you are going to be losing money on the price of the InvIT. We broadly kind of recommend that investors focus on kind of investing in funds, especially when it comes to some of these more complex instruments. But for investors who understand some of these structures, we find REITs quite attractive. It is important to go onto the right REIT. But it's important to understand that your REITs do hold a certain level of risk, similar to your asset yielding fund. And that's really with relation to utilization and the price of the underlying commercial asset.
Ashi, Mr. Vikas Nayak wants to know what your recommendations are for retired senior citizens, if you have something that you can say. And also, I'd request if anybody has any more questions, please do post them at this point.
Mr. Lab, thanks a lot for that question. Honestly, just extremely difficult for me to answer that on a kind of a larger forum, because the way we operate, right, and everything at IME Capital that we do is we're trying to build customized bespoke portfolios to the unique needs of a particular investor. Now, retired senior citizens is a very broad kind of a framework, and while we're aware of a lot of platforms in the industry trying to bucket all of them together, the simple reality is that your retired senior citizens comprise people for whom, one, they really need to rely on the retirement corpus for kind of retirement, towards kind of people who may have sources of income where the retirement corpus is actually just something which is growing and is going to be inheritance for their children. You again have kind of senior citizens who may have been quite active in investing over a period of time, and accordingly then kind of are more comfortable taking on a certain level of equity risk, or you have other senior citizens who may not be. You really need to sit and understand the unique requirements of a person, and that is what our private bankers at IME Capital are meant to do. A lot of you would already be in touch with them. Any of you who may not be in touch with an IME private banker, you have a WhatsApp number. Please do send a message and we will connect you with one of our investment experts. They'd be able to sit and understand what your financial goals are, what your risk profile is, what your preferences, beliefs, etc. are, and be able to craft an investment strategy that meets your specific requirements. Now, specifically when it comes to kind of retirees and senior citizens, one of the main things we help really answer is, one, what is the level of risk that you should be okay taking? Secondly, how do you make your portfolio as tax efficient as possible? You have paid taxes through all your kind of working career. We try to minimize your taxes once you've retired. And the third element is really giving you visibility over how long your retirement corpus would last. One of the things we've actually seen in some of our discussions is we've actually come across a lot of senior citizens who have a fairly large corpus, and actually it's very comfortable for them to actually spend 2 or 3 times what they're currently spending. But a fear or uncertainty, right, actually makes it a lot more difficult for them to actually go out and spend while they actually have the ability to do so. One important element just to kind of complete this is we offer all investors a complete free 30-day kind of consultation, right? We'd help craft your financial plan. We'll build your investment mandate. We'll kind of come up with our investment recommendations, have a look at your existing portfolio, and give you our kind of our recommendations in terms of how we believe this could be better managed. This is absolutely free. There's no commitments whatsoever. We are so confident about our ability to add value that we are willing to put in all this effort, because we're quite confident that we will be able to find ways to optimize the portfolio further.
Ashi, thank you. Shweta Mohan has a question. She's asking, doesn't the higher yield make up for the potential for credit loss? I have a couple of more questions after that.
Sure. So the higher yield, right? And I'm assuming this is with relation to kind of the high yield AIFs. That is exactly the way they are structured. Right. So, and it all comes down to a question of probabilities, and those probabilities can move around. But the way these portfolios are kind of structured, you're kind of saying that there may be a 30 or 40% chance, or say a 40-50% chance of being able to go through a 4 to 7 year period without a single credit event taking place. If this were to happen, you would actually end up with potentially a double-digit post-tax return. It's what is should be considered a best case scenario. There is a 30, 40, 50% probability of that happening. There's then about a 15-20% probability, and these are just broad ranges I'm taking of a single credit event taking place. Now, the way these are also structured is if that credit event happens towards the end of the fund, where you've already earned a lot of your interest, the impact would be lower. If it happens at the start of the fund, the impact would be higher. But typically, if there's only a single kind of a bond that goes bad, a high yield debt AIF would actually outperform the vast majority of other fixed income options. The problem is what happens in the case if there are two, three, or four credit events. And this is where you can kind of get the higher yield doesn't compensate for that higher risk. And you could kind of be in a situation where you're making kind of very low single digit returns, arguably flat returns after 5, 7 year period, or in a worst case, even negative. So it's really a question of probabilities, and which is why it's different investors would approach this in a different way. A 60 or two-third probability of making higher returns for a lot of investors may seem to be the thing that guides them. But for some other investors, they may really focus on the fact that there's a one-third probability that you could actually do quite badly.
Okay, Ashi Banu Singh wants to know, do you have any plan for NRIs with lump sum investments to grow and sustain the wealth through PMS services?
So again, absolutely yes. In fact, NRIs are a very important segment for us. Over one third of our clients and one third of our AUM is actually NRIs. We have a Singapore structure so we actually have offerings for NRIs, which is not just for Indian assets, but for overseas assets as well. And this is not just for NRIs, it's also for domestic investors. We believe it's very important that investors diversify across kind of geographies. Now, again, we are an open architecture wealth management firm. We have a very exhaustive range of options around PMSs, mutual funds, AIFs, global investment options. But again, the specific fund, right? The specific fund that makes sense for you. That is something which, again, we really have to understand, because some of these things are quite nuanced. If you are in the UAE, it is better you invest in a mutual fund rather than a PMS, because of kind of double tax avoidance agreements that allow mutual funds to be tax free. If you're a US NRI, on the other hand, it's the exact opposite. A PMS is much superior to a mutual fund or an AIF because of something called PFIC. Now, this is where the whole consultation with the investment expert really comes in, because we can understand the specific unique requirements, and really help you understand what is the best solution for those specific requirements of yours.
Ashi Anand Sogani wants to know that for investors in the zero tax slab, which is the income under 12 lakhs, would FDs be a more favorable option compared to arbitrage and other more advanced fixed income instruments?
Yeah, sure. Firstly, Mr. Sugani, thank you so much for a lot of your feedback, which Srini keeps passing on. They are very valuable, and we do keep note of that. In terms of your question, I think the answer is yes, right? If someone doesn't have to pay any tax, right, or on a zero tax slab, what is the most efficient option for them? I would argue that a debt mutual fund is still superior to a bank FD, primarily around because of the flexibility it offers, right? Around the fact that no one's asking you what tenure you're investing for. You can put in a crore. Tomorrow you need 10 lakhs. You can just withdraw only that 10 lakhs. You don't have to break the entire debt mutual fund. But apart from that flexibility perspective, a debt mutual fund, a bank fixed deposit, where tax is not a consideration, are fairly kind of similar. And if again tax is not really a consideration, The main other element is, do you want to try to chase a higher return by going to some of these riskier options? But X both of that, I think a lot of our investors do tend to be on some of the higher tax slabs. And out there, typically bank FDs are not recommended.
Ashi, there's a follow-up comment to the questions about InvITs and IndiGrid, and Padmanabh has said that the returns on REITs are very low, akin or lower to FDs.
Yes, right, because then you're not taking that much risk. So if you're looking at a REIT, effectively you are investing in a fully constructed commercial property which is already leased out. There's a strong regulatory environment in place to prevent the REIT from getting too adventurous in terms of incremental acquisitions. It is structured in a manner that is quite kind of secure. Uh, it's important to understand that you can't compare a REIT yield to a bank FD yield or a debt mutual fund yield, because your bank FD and your debt mutual fund yields are kind of constant. I know they move up and down with interest rates, but if you just ignore interest rate movements, you actually have a flat interest rate each year. With a REIT, you actually have the rental income typically increases by 15% on average every 3 years. That's approximately 5% per year. And therefore, the stream of cash flows that a REIT actually provides you is actually increasing consistently over a period of time. And when you discount that back, right, that is effectively how you come to the market price of the REIT. So REITs are attractive. It's just that they're not exceedingly attractive. They are an alternative. It's just important to understand how they are. Your earlier question was with InvITs, right? InvITs have the exact opposite problem. REITs have cash flows that move up over a period of time. InvITs very often have cash flows which move down very often in steps. 5 years later, you may suddenly see a 10, 15, 20% fall off in the cash flows being generated. 5, 10 years after that, it may fall off further. And some of these InvITs actually have cash flows that go away. You really need to understand the underlying kind of asset quite well to understand how, because these are ultimately the stream of cash flows that you get, which is why we kind of prefer REITs to InvITs. And I can tell you the inner workings of InvITs, right? That data is just so difficult to get to be able to value them effectively.
Padmanabh, I hope that answers the question. Ashi, there is another question, and it comes from Pankaj T. Absolute long short buy and sell only equities? Can they sell fixed income securities as well?
So the focus tends to be on equity. I think that's a space that people are a little more comfortable with. Now, there are, however, absolute long short funds that only do commodities, right? It's really a function of how that is defined. The majority of the absolute long short funds that we've seen in the market with a slightly longer tenure tend to be a little more focused on the equities markets, because see, there's enough options, enough things you can do within just a liquid equities market without having to go into too many other asset classes. But can they? It's a function of how that fund has been structured. It will differ from fund to fund.
And Krishna wants to know, are these investments completely risk-free, or is there a possibility that futures or the underlying stock could behave differently than it is expected to?
Okay, so I think here it's very important to understand that absolute long short is not risk-free. It is low risk, it is market neutral, but there's a fund manager who's taking a call on a particular market environment. If the market behaves in that way, they'll make that small positive return. These strategies are designed in a manner to ensure that the returns and risk are low. What is virtually risk-free are arbitrage funds. Now, the reason an arbitrage fund is considered virtually risk-free, and you'll also see returns being very similar to other risk-free assets, is that by definition, it's not a question of a market environment, market sentiment, liquidity in the market, or any such thing. By definition, the the expiry price of a future contract is equal to the closing price of the stock on the date of expiry. It is how the exchange has defined the futures contract. There is no question about this. This has to happen. So I sit, and when I sell this at a higher price than the stock which I've bought, I bought a stock at a lower price and I've sold a future at a slightly higher price. I am going to reverse this transaction when both these prices are the same. And the premium is what I am going to sit and earn. This is uh, nothing in life is 100% guaranteed, but from a structure perspective, this is just fundamentally how it works. Now, from that construct, there is really very, very low risk. There are few tail kind of risk. Now, what happens is that if you've sold a future, if the stock price moves up, the margin requirements can move up over the month. That could increase the amount of capital you have to deploy into the strategy, and you may have entered the strategy expecting 7 or 8% returns. You may end up with about 50 basis points or 100 basis points lower. Secondly, if you have to unwind the strategy in the middle of the month, the price conversions doesn't have to have fundamentally have happened. But I think one way of even just looking and understanding this risk, and let me just very quickly kind of go into our RMS that some of you may have seen. If we're just looking at kind of arbitrage as a category, and if you just look at the difference in fund yields, you will notice all funds in arbitrage give you virtually the same kind of return. It's because of everyone's doing the same thing and it's all kind of largely risk free. Honestly, the way I look at arbitrage funds is having a risk very, very similar to a bank fixed deposit. I would argue from a pure theoretical construct, you could argue that it's even lower, because if a bank goes bust, you technically have 100% of capital that could be at risk. But just suffice to say that this is a very, very low risk strategy. And you can look at any arbitrage fund over the last 15, 18 years, you will struggle to find a month where they've given a negative return.
I would just request if anybody has any other questions. In the meanwhile, Ashi, I will ask you one more question from Tej, who's asking, how about gold and real estate? Are these good alternatives?
Okay, so
I feel like you expected that question, Ashi.
yeah, no, but also partly that's kind of a little out of the context because we're looking at fixed income. Now, again, one of the things we'd really like to stress upon, there's nothing like a good or a bad investment, right? It's something good or bad investment for you. And I think that is really what this whole mandate process and that consultation with the private banker really helps kind of understand. But, you know, just to kind of think, and we've got kind of detailed blogs on our website. If you can just also post the question on our kind of WhatsApp chat, right? All of you would have used the WhatsApp chat to sign up. You can just use that to reach out to us, ask to speak to a private banker, raise a question, etc. We man that quite closely. Uh, Gold is something which we've got an entire blog here which really talks about what people just don't understand about gold. We actually see this as a highly risky asset class. This blog really looks at kind of longer term kind of returns and argue and tries to check, right, these typical arguments for holding gold. It's a hedge against inflation, it's a storage of value, it's a hedge against excessive money printing, it's a hedge against home currency depreciation, right? Do any of these hold true? And if you look at kind of longer term price movements, and we have kind of looked at price movements over the past 50 plus years, there have been extended periods of time, right? You've seen a 2-decade period where gold prices were down 63% in dollar terms. over the last decade, most people have forgotten this in the context of the current meteoric rise of gold. But just kind of, if you were sitting in 2017 or 2018 and you looked at your 5-year rolling returns on gold in dollar terms, you'd be down minus 35%. Gold is actually a very risky asset class, so definitely can't be considered similar to fixed income. The other element is we've also got kind of blogs with relation to kind of real estate. We tend to publish a lot of stuff on our blog, but I think real estate, you really can't compare it to fixed income. Equity is probably a better comparison. And this really just really looks at kind of real estate versus kind of equity. And it looks at risk from multiple different elements. And our argument is that we actually believe real estate to be a lot riskier than equity, especially if you're looking at investing in equity with the right context.
Ashi, Padmanabh has just, also posted a comment saying that one of the drawbacks in a credit or high yield fund is that any defaults or loss directly impacts the NAV, unlike banks or NBFCs, which have cushion in the form of reserves to absorb that loss.
Absolutely agree. Completely, absolutely agree. As in, when there is a kind of any default that happens in a high yield fund is going to impact your NAV. And that's why I broadly gave that maths, saying up to kind of one default. And if that happens later in the fund life, you may still be able to do fine. But if the moment your number of defaults crosses 2, or if the defaults happen fairly early, it is going to impact your returns quite substantially. I think the one, especially in the context of the name of the webinar, right? We said beyond fixed deposits. Uh, Fixed deposits have two elements. I think firstly, if there is a certain amount of defaults, there are reserves to protect against it. But it's extremely important to understand that forget kind of global incidents. In India itself, we've had multiple incidents. Cooperative banks, so I think every few months, there are a few cooperative banks that go bust. But even if you're kind of looking at your full-fledged kind of scheduled commercial banks, you've seen Global Trust Bank go bust. You've seen Yes Bank go bust. There was a time recently where a couple of the other private sector banks where there were quite a few concerns around them. The thing is that if a commercial bank goes bust, from a legal perspective, investors can lose 100% of their capital. The problem from a government perspective is this can really shake a lot of confidence in the financial system, and which is why very often depositors are bailed out. And that is what you saw in Yes Bank. Fundamentally or legally, most depositors should have lost 100% or a very large amount of their deposits. The government kind of got together a bailout. But if a bailout were not to happen, the problem with the bank FD is that all the capital above 5 lakhs could be at risk.
I think we can close this out, Ashi. We have addressed all the questions. We also have some great feedback, and everybody's saying it is very well covered and presented. Not everybody may have this sort of information. I understand that some it is a little technical, but most people have found this extremely insightful. So thank you so much, Ashi, for your time and for explaining everything. And thank you everybody for joining us. I would urge you all to please keep in touch with us via our LinkedIn page, where we will be posting about future webinars and sessions, because we do these quite often. Thank you, everybody, and have a great evening. Thank you so much. Thank you, Ashi.
Thanks a lot, everyone. Thanks, Shagun.